Did you know that Canadian construction costs are now rising at more than twice the central bank's target inflation rate? It's a critical issue that's impacting the real estate market across the nation, particularly in the multifamily sector. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Canada's building sector is adding more fuel to inflation, according to recent data from Statistics Canada. In the second quarter of 2025, construction costs grew sharply, with quarterly growth now running at twice the central bank's target inflation rate. This accelerating price growth presents a new inflationary challenge, attributed to counter tariffs and a shortage of skilled labor needed to meet the excess demand from builders. To break it down, residential building costs climbed by 1% in the second quarter, running at an annualized growth rate just over double the Bank of Canada's 2% inflation target. This was an increase from the 0.9% growth reported in the first quarter, with prices up 3.7% since last year. Non-residential building costs are rising even faster, with a 1.6% increase in the second quarter of 2025, following a 1% growth in the first quarter. These costs are now 4% higher than last year, with annualized growth for the most recent quarter running at more than triple the Bank of Canada's target inflation rate. The sudden return to acceleration in building costs was driven by several key segments last quarter, including plumbing, HVAC, utilities, and structural steel. Notably, rising steel prices are a significant obstacle for multifamily construction, partly driven by protectionist policies enacted in the past. Construction firms are attributing these rising costs to counter tariffs and labor shortages. In response to United States tariffs, Canada implemented counter tariffs on certain U.S. imports. While these measures were intended to level the playing field, they have had the opposite effect, leading to higher prices for goods and increased input costs for end users. Statistics Canada notes that these counter tariffs have not only resulted in higher builder costs, but also supply shortages and project delays, all contributing to the rising costs of housing. Furthermore, builders have cited a persistent skilled labor shortage as a major cost driver. The cost of labor won't decrease without a surplus of workers, and the aggressive building pace that has driven the industry to overcapacity is a direct result of efforts to attract skilled labor through ambitious immigration targets. The recent slowdown in population growth may help cool demand, but it will take time to see these effects. Meanwhile, the newly elected government's mandate to double the rate of new homes built seems to be at odds with the current population growth trends, which might indicate a potential policy shift in the future. The belief that real estate is an unbeatable financial asset is being challenged as Canadians face a shifting market landscape. According to Tim Schufelt from the Globe and Mail, the once rampant Canadian real estate market is showing signs of cooling, with national average home prices declining by about 15% from their peak, as reported by the Canadian Real Estate Association. This is particularly evident in some of the hottest markets like Toronto and Vancouver, where condo sales have significantly decreased. It's an interesting time for the market, as Canadians are beginning to reassess their faith in real estate as an infallible asset. Economist Mike Moffat, who is also the founding director of the Missing Middle Initiative, points out that every generation seems to need a wake-up call to realize that housing isn't always a surefire investment. The last major downturn in Canadian real estate coincided with the early 1990s recession, lasting nearly a decade. But memories of such events tend to fade, and since the early 2000s, the market has been on an unprecedented rise, with home prices increasing fivefold. During this period, many Canadians became real estate enthusiasts, investing heavily in the market and viewing their homes as retirement funds. This mindset was fueled by the market's resilience, especially when compared to the United States, where the housing market collapsed during the global financial crisis. Canadian housing, however, remained relatively stable, further enticing investors with its perceived security. Yet, as Schufelt notes, the reality is that housing, as an investment, may not be as strong as it seemed. When compared to the stock market, the average Canadian house has appreciated at an annualized rate of 5.5% since 1980, while the S&P/TSX Composite Index has generated an 8.9% annual return, including reinvested dividends. This stark difference highlights the importance of diversification and cautious investment strategies. To illustrate, a $100,000 investment in the average Canadian home from 1980 would now be worth about $1.1 million. In contrast, the same investment in the stock market would have grown to approximately $4.8 million. While this is a generalized example and doesn't account for regional market differences or property types, it underscores the potential pitfalls of relying solely on real estate for wealth accumulation. Of course, there are benefits to owning a home, such as security, forced savings through mortgage payments, and the potential upside of leverage. However, as a pure investment, housing may not be the guaranteed winner it once appeared to be. This realization is prompting many Canadians to reconsider their financial strategies, particularly as they approach retirement. Mortgage strategist Rob McLister warns of the retirement risk that comes with over-reliance on real estate. If the market doesn't meet expectations, many could find themselves in financial difficulty. It's a reminder of the importance of a diversified portfolio and setting realistic expectations for any investment, including real estate. While the current market adjustments may be challenging, they also present opportunities for savvy investors to reassess their strategies and find new avenues for growth. By keeping a balanced perspective and embracing a diversified approach, Canadians can navigate these changes and continue to build their wealth. In a significant development in the Canadian real estate landscape, BGO has announced the successful final close of its Bentall Green Oak Canadian Value Add Limited Partnership, securing 247 million Canadian dollars in capital commitments. This is BGO's inaugural value-add real estate strategy in Canada, specifically designed to meet the growing investor demand for higher return strategies across the country's largest and growth-oriented markets. The Canadian value-add strategy received robust support from 9 institutional investors, including financial institutions, insurance companies, and corporate as well as university pension plans. Notably, all capital was raised domestically, highlighting investor confidence in BGO's Canadian platform and execution capabilities within the value-add space. Christina Iacucci, head of Canada at BGO, emphasized the strategy's unique investment approach, stating, "Our Canadian value-add strategy offers a differentiated investment strategy that reflects BGO's deep roots and long-standing commitment to the Canadian real estate market. This strategy is crafted for institutional investors seeking new waves of value creation in key growth corridors across the country." The strategy focuses on capitalizing on growth opportunities in Canada's top real estate sectors and markets, utilizing a hands-on asset management approach and best-in-class operating principles. It currently provides exposure to a mix of multi-residential and industrial assets, with 4 investments completed in Vancouver, Greater Toronto, and Hamilton, and Montreal. This activity underscores BGO's ability to unlock value amid shifting market conditions. Chetan Baweja, Managing Director and Head of Canadian Value Add and Separately Managed Accounts Platform at BGO, noted the benefits of a data-driven strategy, extensive local networks, and a relentless focus on proactive management. These are key hallmarks of BGO's approach in markets where they have deep experience and institutional-grade asset management capabilities. The Canadian value-add strategy is powered by BGO's fully vertically integrated platform, benefiting from in-house capabilities spanning research, property management, leasing, and development. This end-to-end integration allows for execution across the asset lifecycle, with many transactions sourced off-market, a differentiator stemming from BGO's national presence and trusted relationships. The strategy is led by Chetan Baweja and further supported by Christina Iacucci, along with a 10-person investment committee comprising BGO's senior Canadian and global leadership members. This team leverages decades of real estate expertise to act decisively on opportunities for their partners. BGO, a leading global real estate investment management advisor, serves over 750 institutional clients with approximately 86 billion United States dollars in assets under management, as of March 31st, 2025. They have a strong presence in 25 cities across 12 countries, bringing deep local knowledge and extensive networks to their investment and management activities. The announcement of BGO's Canadian value-add strategy marks a promising opportunity for multifamily and industrial real estate investors, showcasing the potential for growth and value creation in these sectors. With a solid foundation and strategic approach, BGO is well-positioned to navigate the evolving market landscape and deliver substantial returns for their investors. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, MacKay. See you on the next one.